What if I told you the single biggest lie in finance is that market crashes destroy wealth? It sounds crazy, right? We see the headlines, we feel the panic, and we watch portfolios bleed red. But if you look at history, a very different story emerges. Almost every great fortune you've ever heard of wasn't built during the sunny, easy years. They were forged in fire. The Great Depression, the brutal stagflation of the 70s, the dot-com implosion, the 2008 financial meltdown, even the sharp panic of 2020. Each of these events wiped out unprepared investors. They were devastating for millions. But for a select few, they were the opportunities of a lifetime. These weren't just lucky gamblers. They were people who understood how markets truly behave under extreme stress. So when people start whispering about a potential market crash around 2026, the question isn't if markets will fall. They always do, eventually. The real question is, who will be positioned correctly when it happens? This isn't about being a doomsday prepper or predicting the end of the world. It's about understanding simple, powerful cycles. Markets don't move in a straight line up. That's a fantasy. They expand, they overheat, they correct, and then they rebuild on a stronger foundation. What makes the current environment so fascinating is that we're seeing several massive long-term forces all converging at once. These are the kinds of forces that have historically preceded major market resets. For the first time in over a decade, interest rates are genuinely high, making money expensive again. Governments around the world are groaning under record levels of debt. Global supply chains, which we all took for granted, have proven to be incredibly fragile. Demographics are shifting in ways that will reshape entire economies. And perhaps most importantly, investor psychology has flipped. The era of easy money and stonks only go up is gone. Now, none of these things alone guarantees a crash. But when you mix them all together, you get a recipe for volatility. And here's the secret. Volatility is where opportunity is born. Most people react to downturns emotionally. It's human nature. Prices start falling, the news turns terrifying, and fear spreads like a virus. In those moments, selling everything and hiding in cash feels like the only safe, rational thing to do. But markets don't reward emotional reactions. They reward cold, hard preparation. If a major correction does hit around 2026, it will likely follow the exact same script every crash in history has followed. First, there's disbelief. This is just a small dip. Then comes denial. It'll bounce back next week. Then the panic sets in. Then the forced selling begins as margin calls hit and people need cash. And finally, after the chaos, comes the quiet generational opportunity. This is the moment of the great wealth transfer. During a market crash, assets don't just vanish into thin air. They change hands. They move from the fearful and the over-leveraged to the patient and the prepared. Stocks, businesses, real estate, entire sectors get repriced, not because their long-term value disappeared, but because short-term fear completely overwhelmed rational judgment. History shows us that the biggest gains don't come from perfectly timing the bottom. No one can do that consistently. The biggest gains come from having cash, being patient, and staying disciplined when everyone else is running for the exits. Think about what actually happens during a crash. Incredible, world-changing companies with strong cash flow get thrown out with the garbage, their stock prices plummeting alongside failing zombie companies. High-quality, long-term assets get sold for pennies on the dollar to cover short-term losses. Investors who use too much leverage are wiped out, forced to sell at the absolute worst possible moment. In a crash, quality goes on sale. But it's a sale only for those who have the cash and the courage to shop. This is why preparation is infinitely more valuable than prediction. Being prepared doesn't mean you're betting on disaster. It means you accept the reality that markets will face stress at some point, because they always do, and you structure your strategy accordingly. One of the biggest mistakes people make is thinking crashes are random, unpredictable events. They're not. They are the predictable result of imbalances that build up quietly during the good times. Too much debt, too much confidence, and a complete mispricing of risk. The correction itself feels sudden and violent, but the causes were brewing for years. If volatility spikes towards the middle of this decade, the most valuable asset you can own won't be some secret stock tip. It will be emotional control. The people who not only survive but thrive during downturns do a few simple things very differently. They avoid excessive debt and leverage like the plague. They always maintain liquidity, keeping cash on the sidelines. They think in terms of years and decades, not days and weeks. And they understand a crucial truth. Markets always recover long before the headlines do. Think about every major recovery in history. Stock prices started turning upwards while the news was still filled with doom and gloom. Widespread confidence only returned after the best opportunities were long gone. The time to buy is when you are scared to death, but your analysis says it's a bargain. This is why the idea that a crash can make you rich isn't about one lucky trade. It's about positioning yourself for what's called an asymmetric outcome, where your potential downside is limited, but your potential upside is massive. Crashes also reward learning. Investors who take the time to understand balance sheets, cash flow, and long-term industry trends can separate temporary fear from permanent damage. They don't chase the hype during the booms, and they don't abandon logic during the busts. A potential downturn in 2026 wouldn't be unique. What would be unique is how many people remain completely unprepared, despite having over a century of historical examples to learn from. The market doesn't punish optimism. It punishes blind overconfidence, and it doesn't reward fear. It rewards patience. If volatility does ramp up, the biggest opportunities will show up exactly where confidence has disappeared. Sectors that are written off as dead. Businesses that are assumed to be finished. Assets priced as if the future has been cancelled. The goal isn't to hope for a crash. The goal is to be ready if one happens. Because the truth is simple. Wealth isn't built by avoiding risk. It's built by understanding when risk is fundamentally mispriced. And there is no time that risk is more mispriced than when fear has completely taken over from logic. History doesn't repeat itself, but it often rhymes. Those who prepare during the calm periods rarely have to panic during the storms. And those who panic during the storms often spend the next 10 years just trying to get back to even. If the next major market reset comes sooner than we think, the real dividing line between those who lose and those who win won't be intelligence or luck. It will be mindset. This is Legacy of Money, where history, markets, and strategy meet. Thanks for watching, and don't forget to subscribe for more insights on building lasting wealth.